Welcome, everybody, to another week of Wealth Wisdom, where we're helping you build wealth and legacy.
Companies are like an organism trying to survive.
It's always a risk when you're investing in a company that's purely tied to someone's brand.
45% of Americans have gone into debt for a Disney trip. All right, welcome back to another episode of Foxhill's Wealth Wisdom, the podcast where we break down complex financial concepts into actionable strategies for you to take home and create lasting wealth. I'm your host, Justin Obi. I'm here with my amazing co-hosts, Eric Benz and Bill Ryan. What's up, guys? How are we doing?
How we doing? Very good. How you guys doing?
Doing great. Today's a great day. It's Friday.
Yeah, I'm
Every
already
time,
at
every
two
Friday.
cups of coffee, so we're good.
I took down a couple espresso shots myself, so
Yeah, there you go.
feeling good. I've been up since 4.
Little cold brew this morning, and then an espresso when I got here.
Ooh, nice.
So,
You make that yourself, right? That cold brew?
oh yeah.
I love it. All right, well, today we're diving into retirement, specifically how much you need to have in retirement and how you're going to allocate your assets according to us and what the old way and the new way is. So stay tuned for that. It's basically the reason why we're doing it. It's a question we get all the time. So we figured why not answer it publicly to you, our listeners here on the show. But let's first rapid fire market news. Eric, what are we looking at this week? It was pretty good week.
A lot of stuff happening. Americans spent $14 billion on Prime Day, Amazon's Prime Day.
Yeah, that's insane.
It was also spread out over 4 days this year, but
Yeah.
that was a 24% uptick. A lot of it was planned purchases, not just impulse buying. And it's heavily focused. Gen Z is like the main customer base there.
Which is like the brokest generation, which is insane. You know, like they're most.
Hey, and you figure that's good for Amazon as that generation gains more wealth, ages up, inherits from the boomer generation. They'll be spending even more on Amazon. Okay, also rumors, right? Trump, is he going to fire Powell or not? Yeah, right? Turns out he's not. Markets rallied on that news.
That was interesting because the market fell when the rumors hit,
Yeah.
and then
That's because
Okay, but everything I've read
is important.
Everything I've read is saying that he can't do it anyway.
Yeah. No,
I mean, I know, like, I don't know.
yeah,
maybe
yeah, and I don't think. I mean,
or something,
yeah,
right? So what? I don't understand what the big hubbub is about this. When it's like, for the most part, he can't make that decision anyway. So why? I don't know. I just feel like all this stuff sometimes it's just such a stupid distraction on.
yes, definitely a
Talk
distraction.
about it. He wants to just bring it up, thinks that he can just, you know what I mean, start yelling at stuff, and then stuff is going to change. But you when you can't do anything about it, it's like just let the guy serve out his term. He's been pretty good. I would say, like, the only, you know what I mean, times he really kind of screwed up was like right after the pandemic, but we were still wondering kind of what was going to go on. So they probably kept rates too low for too long. Might have been, maybe you should have been a little faster on the raising of rates, you know, rather than going up like 1%. Maybe you should have gone up at 2 points or something like that a few times, but it just kind of gotten it over with. But
that was also exacerbated by the Ukraine war too, though. Like energy prices spiking.
yeah,
He was dealt a bad hand there. He tried his
and
best.
even now, inflation just came in the other day at like 2.7.
Yep.
So it was up from 2.4 and 2.3 the previous month. So, I mean, it's not like there's all these bells and whistles out there saying that we should be lowering rates. There's other indicators that saying that we shouldn't be.
Yeah.
So it's not like he's doing, you know what I mean, anything that crazy. I mean, obviously you don't want to be too slow with it, but I can't really say that the guy has been like, he has just been a dog, and you know what I mean, terrible. You know, I just don't see it. Let the guy serve out his term. Let him work his job and independence. I know you guys are probably saying, no, we should be lower rates.
We gotta lower rates.
That's just the way yeah.
No, I mean you've got a great point, because also I think the government reported just yesterday, lower than expected jobless claims, which is, I think, a reason not to. The betting market right now is the odds went down for a September rate cut.
Yeah,
because of that. Okay.
Yeah.
Because, too many. Yeah, you need people to lose jobs for inflation to go down. So.
Yeah, and the job market's strong. I think more just like the real estate market. I just feel like it's still priced so. Everything is just priced so high. I know I've been saying that forever.
Yeah.
And I know again, there's just nothing on, or not as much on the market as there needs to be really for there to be excuse me, to be affected by it. But that's where like rates would help, right? Is all things
you would hope
real estate related.
You'd hope. I mean, the past few
could
rate
drive
cuts,
up prices though, right? Yeah.
Yeah, it could drive up prices. Yeah, that's it. That's a whole interesting issue to jump into, because like the 10-year has not moved down on the past couple rate cuts. So it's interesting. Yeah, I know.
Our national debt, right, and stuff like that.
People are losing faith in
yeah.
Exactly. No, so it's not necessarily like they cut rates and then real estate becomes cheaper.
Literally deemed a riskier asset, right? U.S. real estate. Who would have thunk it?
So let's dive into the main topic. We've got, I think retirement overall has changed. You've got the average retirement length is now
actually, can we talk about Nvidia for 1 sec before we even get into that?
Yeah. That's just a good one.
Just with it passing the $4 trillion mark in valuation, I mean, that's
blowing through that.
Yeah. So I mean, I just feel like that's kind of a huge news story.
That's
to
right.
have any company that's worth that much money, that's worth more than I don't know how many sectors in the United States. You know what I mean? In valuation alone, I think that's just it's unbelievable. And also too, the fact that they have reached some type of deal where they can now do chips with China, right? Which for the longest time was very much up in the air, and so that's a big thing. I know, like. The CEO, Jensen, he's been saying how he's like, listen, if we want to control, like, it's better that the U.S. controls that market because they're going to get it somewhere. And like we saw with DeepSeek, they're going to develop it. So if we're not the ones doing it and making, I don't know what Nvidia's margin is. It's some ridiculous number on how much money they make off these chips. But if we don't control that market, it's actually going to be more detrimental, right? Because they're going to develop the stuff no matter what. It's going to happen. They're going to have competitors no matter what. You have all these companies trying to make their own chips now to kind of, lessen having their dependence on Nvidia. Yeah. And I think that was a smart thing. I mean,
Nvidia's margin 75% as of this past year. Yeah.
Yeah, they're printing money.
Yeah, but I just thought that was a kind of a huge story.
It is
the passing of the $4 trillion and also resuming business with China.
Well, it's also a bigger, even the other, Eric, you've talked about this a lot, is I think it was a quote, maybe I'm wrong, but I don't think I am. You had said at one point, either our private conversations or on the show, that even if people think they are diversified when they buy the S&P 500, and they're really not at all, because even just the Mag 7 makes up for like, I think 47% of it. I think something
That's
like that.
Unbelievable. Yeah. So
but how much? Look at how much Nvidia makes up there.
Can you afford to not own these companies at this point? All monopolies, all done very well. The only one that's really been disrupted has been Google. But even then, like its price has gone up. Yeah, the laggards have been Google and Tesla. But
look at Nvidia.
Apple
accounts for
Apple, you know what I mean, in the last year. So I mean, you have to be careful about which ones you pick. You can't just say I'm going to grab all 7. You know what I mean, and forget about the rest of the market.
But if you're buying an ETF, you are buying all 7. So active management.
Yeah, I mean, we entered a position to Nvidia. Right at its low. I mean, but it was just it was dictated by again the research that we use and things like that. We had to make a decision on. I think we got out of Google,
sold
right?
Google.
But then we got into Nvidia, and obviously it's had a great return the last couple months.
Yeah.
yeah.
Dude, if Google spun off YouTube and we could just buy YouTube as a asset, I would do that in a heartbeat.
That's one interesting about Google is they say like the sum of all its parts are probably worth more than Google's like valuation. Like if you took away, you know what I mean? If you had to sell off YouTube and sell off, you know what I mean, Waymo and sell off, you know, all these things, like it would be worth more than its valuation. So that's the one thing about Google. If people are like, search is dying, search is dying. I mean, as long as they can tweak that, they need to implement, you know, Gemini more and more of their AI and things like that into their search.
Search and like now. But I find myself going to ChatGPT and Claude. This is anecdotal, like way more than Google now. You get the right.
But do you never use Gemini? Do you never use it?
I do sometimes, but it's weird. It mixed in with like I never use that as a standalone. I'll go in the Google search bar and then you get your Gemini answer. It's not.
Yeah.
It's not as good. It's mixed with search. It doesn't. It doesn't feel right.
I find a lot of times it's very, very similar to what I get from like ChatGPT.
Yeah.
I also sometimes the way I interact with it, they interact the same way. They'll give me almost the same token answer.
Mm.
You know, I was looking up, you know, just like nuclear plays within the United States, and then I asked it why it didn't include a few stocks that, you know what I mean, that, you know, Vistra Energy, for example, it did not include that as a nuclear play in the utility space in the United States. Both of them did not include it, which I thought was very interesting.
How's that?
And then when I asked it, why did you not include Vistra Energy? They both answered, you know, you're absolutely right. We should have, you know what I mean, included that, and here's why. Mm-hmm. But I thought it was interesting that they didn't list it initially. Yeah. So I find them pretty similar, but sometimes I get and again, I wouldn't say with any consistency, I get a better answer on some than others. Yeah. Like sometimes with the question, it might be better on ChatGPT. Sometimes it's better on Gemini. You know, but I run it through both of them. I try to use both of them as opposed to just using one and going with it.
Yeah, I think that's smart. It's also the prompt engineering, like how you enter your prompts and what you're doing with that. Grok, have you guys used Grok yet? Just while we're on the topic of these things.
I haven't used it yet.
I haven't used it either, but it made headlines this past week. I mean, they've basically caught up to, or maybe surpassed ChatGPT. So that's an interesting battle that's happening.
Obviously, we're not like big time tech, you know, enthusiasts and stuff like that. But it is funny how you hear people that say, "Oh no, Grok is the best," right? You know what I mean? It's gone massive. It's better.
Well, yeah. I mean, I heard that they talked about that on the All In Pod. I'll shout out to them. And it was a fascinating
I thought Grok had
discussion.
To get shut down because it wasn't conservative enough or something. Did you see those like headlines?
There was also a headline there. They had a big snafu. Yeah, they fixed it, I think. But yeah. All right, are you guys ready to dive into this topic? The people are waiting here. We have people anxiously waiting for you to weigh in. I think the biggest piece on this takeaway for me is just the average length of retirement has drastically changed. So just even looking back to the 90s, just to set things up for the conversation, you have average retirement length in the 90s was 18 to 20 years, and now it's expanded to 25 to 30 years. People have to fund a longer amount of retirement. You had to fund decades, literally decades.
Wait, so that stat though,
yeah,
is that just what was like life expectancy in the 90s? Because I mean, what is
well,
it?
I don't know if the life
78 for a female.
I don't know if it's the stat is dependent upon life expectancy, but I think it's also, I think if people are living
like
longer,
what you need to prepare for. Yeah.
But I think people are also wealthier
74
today.
to 75. In the 1990s, average life expectancy in the U.S. was 74 to 75. So it's gone up.
Okay, so it's gone up. I know like the pandemic was the first time that it started to creep down a little bit.
Yeah.
Between like the pandemic and fat America. Like that.
That was where it was like a lot of social services couldn't like do their job.
Well, I think health plays an incredibly important role in this topic, because
100%.
It could basically dictate how expensive your retirement years are and how enjoyable they are.
Yeah.
But that's a big piece of this. So also with the lengthening of retirement, the time you're in retirement, you also have healthcare costs rising drastically, way above inflation.
Oh yeah.
I mean, yeah. So I guess Bill, start us off. Like, how do you view retirement? Are there the different phases of it, and how we think about helping people prepare for it?
Yeah, I mean, if you think about early on, right? And I'm going up on the notes here and looking at, but we got the go-go years, right? So that's like your
Yep.
initial retirement. A lot of people that's around age 65, but it could be anywhere, right? So I mean, could be earlier than 65,
Sure.
but you're looking at that 65 to 75s, 65 to 80 when you're doing a lot of stuff, right? You're planning those trips that you were putting off for years and years and years and couldn't do because maybe you're trying to put kids through college and
Yeah.
pay down your mortgage and you know what I mean, whatever, and save as much as you possibly could, right? So now you're active,
You're
you're
free.
mobile, and you're free, and that's you know what I mean. That's kind of the start of it. A little bit after that, maybe you slow down a little bit physically, right? You're not apt to doing as much activity, and you come into your slow go years,
The
and
slow.
yeah, but that might be right after that, right? So if the go-go years are say on average 65 to 75, maybe the next decade, the 75 to 85 is kind of that slow go. You're not maybe doing as much. You're still doing some, but it's kind of reduced, right? In a sense, your spending has maybe gone down a little bit because you're not doing those high cost activities,
Mm-hmm.
and things like that. But and then you kind of come into your later in life, right? And this might be like we're calling this the no go years, and I mean just because like at that point in life you're 85 plus, for a lot of people, you may have some healthcare issues. Those things are kind of creeping up, right? Because healthcare just seems to go up. You're spending a lot of money there, and you might not be as mobile, so you're not gonna maybe take the trip that involves a ton of walking and getting around. You know what I mean? Things along those lines. So I just said, you know what I mean? They're gonna put a
Yeah, that's all good.
buck in my swear jar or whatever you want to call
That's
it.
right. Yeah.
But
But
that,
well, this is how it's so. Sorry, I cut you off, Eric.
No. I was just gonna say, yeah, the issue with the no-go years is that like home health aides, nursing home, all that stuff gets so expensive, and that's why it kind of creeps up. Your cost of living creeps up at the end there.
oh
But,
yeah.
go ahead, Justin. Sorry.
Well, that just what kind of in line with what you're going to say. It's all dependent upon your relative health, your health. And it's like someone said the other day, like treat your body like you're gonna have it for another 100 years.
All right, I gotta make some changes then.
It's remarkable the changes you might make now in your 40s or 50s can make a serious impact later in life.
Yeah, Eric's what I like to call skinny fat. Look at Eric, he's tall, thin, or whatever. It's like, Eric, you ever work out? He's like, nah, I just work. You know what I mean? Eric, you go to the gym, you got that nice gym membership at Brown University with all the great stuff. No, I never get over
I gotta
there.
kill that.
Oh, that's
you have
that's
to
not
use
true.
it.
Eric's working out in different ways. He's golfing. He's doing baby curls right now with
That's it. It's just the baby
Christian.
curls like this, just the shoulder muscles.
Yeah, that's a serious workout. You try holding a baby. You'd be like, ah.
Yeah, dude, my back's messed up. That's the problem. But
That's why you should be doing some strengthening at the gym. That way
Yeah.
we ball you.
I think we should still gym sessions. After we record Fridays,
I'd be
or before we record rather. All right, so old way versus new way. Eric, guide us through this.
yeah, it just people used to say, "Oh, take 4% out of your portfolio. That's a good barometer."
Safe.
Each year, right?
Yeah.
In retirement. But now I don't know. Some people do less. Some people do more. It's become a very fluid thing, based on a financial plan. So everything's way more customized now than it used to be.
Mm-hmm.
So that's the whole theory is like, oh, maybe in your go-go years, maybe you're taking out a greater percentage, or maybe you've been a great saver and your go-go years, you're not traveling as much, your expenses are lower, and you want to leave funds to the next generation. Some people don't want to leave funds to the next generation, and they're willing to see their account trickle down a little bit over the years. In that case, maybe they're taking more than that 4%. So it's become like a very fluid situation, and we make all different kinds of financial plans for clients based on that.
Yeah, I think that's a really key point. Is how customized we've tailored. We tailor things so well to each individual, and I think that's what people need. It's really important, rather than just blindly following a standard rule. And then, I guess Bill, what's one strategy that you think listeners should focus on? If they're doing it themselves, like they're listening, like I'm gonna try to do this myself.
So, I mean, I think the biggest thing is making sure so when you're accumulating wealth, right, you have a very long time. Your time frame is a lifetime, we'll say. You know what I mean? So
Yeah.
you have a long ways, right? So, but when you're in retirement, one thing that you need to this is a worry, is what's called like the sequencer returns, right? So let's say, you retire and then we head into a 3-year recession or something like that, right? Where your accounts maybe have gone down, the equity portions of your accounts have gone down, and you need to start withdrawing money from that. You want to make sure that you have the money that you're going to be using in the next few years. And again, it's different for everybody, right? But let's say you want 2 years, 3 years, 5 years of money in safe investments. Okay, money that is not going to be not really subject to the sequence of returns in the stock market. Okay, so we'll call it like you have these different buckets. There's a way a lot of people, and I like that. So you're drawing from these different buckets at different times, right? And these will move through your retirement. Okay, so when you're when that money that you're going to be spending those next few years wants to be in safe investments, wants to be, they should be liquid in some, or they should be maturing in the case of bonds, right? So we're using like a bond ladder that, hey, we know what our expenses are going to be each month. We want to make sure those bonds mature, turn into cash. We're maximizing the interest rate that we're getting on them, which is why we want to use those bond ladders and things of those nature. But at the same time, very, very secure liquid investments are going to come, come due. The money's going to be there when you need it. And if we do have a recession where, the equity portion of our portfolios have pulled back even significantly, you say, well, my time horizon is 3 to 5 years down the road. 10 years down the road, this doesn't matter right now. You know what I mean? Right now, it's not even a concern because I've done this front end planning with this part of my portfolio that I know all my needs are going to be met. My travel is taken care of. My mortgage, my taxes, my insurance, my food. You know what I mean? All my spending, that stuff's taken care of because I've done the proper asset allocation of those funds. So that's where that initial bucket should be. Then we kind of go into maybe like 4 years down the road. We want to have more growth, right? So it should be more stocks. If you're more conservative, maybe like more mature stocks, pay dividends, right? You know what I mean? Or more stock buybacks, not necessarily focusing on rapid growth, and that's one thing that you want to have a good mix of, right, within your stock portfolio, and then you're looking at like maybe 10 years down the line, maybe that's where you can have more, or I shouldn't even say 10 years down the line. I feel like that's way too conservative, but stuff for maybe 5+ years, 6+ years down the line, you can have some of those high growth stocks within your portfolio. And that's a great way to have a good asset mix so that you're beating inflation, beating healthcare costs, things along those lines. So,
yeah, Eric, you said the other week that I think you felt like people overall generally are way too conservative during retirement. Am I misquoting? Did I say that wrong?
Yeah, well, just because of what you talked about at the beginning, the fact that retirement is so long now.
Yeah.
Like you're talking about like 30 years in some cases. Like you need that large bucket that's going to keep growing, what Bill was talking about. But basically so that you don't have to touch it in a bad time. You don't have to sell your stock when the market's down. You've got your safety net there, right? Because sometimes it could take a while, right? In 2008,
Yeah.
the market like 4 years to fully recover. Hey, if you already had your safety net on the sideline, that's maybe it's in short-term treasuries or bond ladder, something along those lines. You can be withdrawing from that and letting your stock portfolio recover and then continue to appreciate, because you need that growth in retirement.
Got it.
Yeah. Which, hey,
you would have been in great shape, right? You could have gone through the worst pullback that we probably will see, you know what I mean, see in our lifetime. 47%, okay? $1 million portfolio goes down to 530,000. I mean, imagine, watching that happen.
Yeah. Awful.
And you are still set up to have a fine retirement, right? You could have retired in
I think that's the key.
in July of 2007 and you'd still be fine.
Yeah.
Hey,
Yeah,
you need that money for the go-go years so you can go to a Coldplay concert and take your coworker, get caught on the kiss cam, right? But
run with the bulls on Pimple.
Oh man.
Did you see
I saw that. That's crazy. Trending. That's insane.
They
Apparently
handled it so well.
Oh my god.
Bert was saying apparently that guy's like a PC grad. Yeah.
Nice.
Go figure.
Yeah. All right. So we've talked about the bucketing strategy. We've got covering your short-term years to make so that you don't have to withdraw should things turn for the worse in the stock market. What about taxes? I think tax efficiency is something a lot of people care about as they're withdrawing funds. Bill, how do you look at it?
So tax efficiency at that point, right? What a lot of people, especially nowadays, you hear the Roth conversion. Should we do the Roth conversion so we're not paying taxes later on in life? Also, you hear about, well, taxes are always going up. Taxes are
going for people listening though? What do you mean when you say the Roth conversion?
Roth conversion is when you take a traditional like 401k. Okay, so you hear traditional, you think this. It's pre-tax going in.
Yep.
Tax deferred as it grows, and then it is taxable when it comes out in retirement. Okay, so you pay ordinary income tax. You also are subject to what's called required minimum distributions. Okay, right now that starts at 73. In a few years, it's going to go to 75 if you were born in after the age of after the birth year of 1959, right?
Okay.
It will go to 75 in a few years, and that is something that people say, oh, what is that going to do to my taxes once I need to start having these distributions taken out? So a popular topic now is saying, hey, should I convert the money to a Roth? And what happens is that once you do that, your money still grows tax deferred. It will be tax free upon taking it out. And then, so people say, hey, should I pay it now? Okay. The problem with that is that if you are to convert, that money, that's a taxable event. So you have to have resources elsewhere. Okay. So you have to say, you have to have this money in your checking account, for example, to then pay that tax bill now.
Mm-hmm.
You're dealing with a lot of variables. Maybe taxes go up, maybe they don't. Right? Oh, I've heard my whole life since I was started in the industry almost 20 years ago that taxes are going up. We've got this national debt, right? It's mounting. Who do you think is going to pay for that? They're going to raise taxes. That's how it's going to happen.
Yeah.
Since then, I don't think we've ever had a tax increase. so you hear that, and I don't know if it's ever going to happen. And then you hear other things saying, well, hey, once AI gets involved and things like that, we're not going to need to do tax increases. This debt's going to get taken care of by itself.
Just grow our way out of it.
Yeah, maybe not.
U.S. is like
I don't
a growth
know.
company, right? Think of us like a big tech company, the country as a whole. That's the thing.
Yeah, right. So, I mean, there's different schools of thought, though, like what's going to happen. I mean, I still think the best thing is to have a mix. So we talk about buckets of how we invest our money, right, early on. Well, why not have some Bill, differences in taxes, you know what I mean? So have some money in Roth.
I have a planning question about Roth conversions. When you're taking that money out of the IRA and you have to pay taxes on it, can you withhold a portion of that to pay the taxes, or do you have to pull money from like a taxable account that you have, like an individual brokerage or a checking account to pay the taxes? How does that work?
So you can do both, but here's the thing. Say you want to convert, I don't know, let's just use $100,000.
Yeah.
Right? If you want that $100,000 to hit the Roth, you need to gross that up, right? So it now needs to be, depending on what other incomes you're in, but let's say you're paying 30%.
Yeah.
Yeah. You're going to have not 130, you're going to have 130, something to net $100,000. You know what I mean? $100,000. So that's the thing is you can do it. You can do it, but you've got to gross it up more.
I have a client not in retirement age, actually. They're pre-retirement and they're between jobs this year, so their income is going to be a lot lower. They have a Roth IRA, but they have more funds in their regular IRA. Would you recommend doing a conversion right now? And they do have funds for living expenses, but since their taxable income this year is going to be a lot lower.
Certainly, yeah. I would say, you know what I mean? Go ahead and do that. Just be aware of the consequences. So that's something where you really want to work with your planner, your advisor, or if you know how to do it yourself, just make sure that you're not getting, you just don't want to get those surprise bills in April, right? So, I've done that before. I had a client who was had been in an industry for a long time, decided to make a career switch, was going back to school. And I said, hey, what are you doing with your retirement accounts? Have you made any plans? You're going to be out of work for 2 years, living off loans and things, or savings and stuff like that. I'm like, now might be a great time to do a Roth conversion. Yeah. So we were able to convert over the course of like 2-3 years at a zero tax rate. Okay. So, because what I did is I took advantage of, there was an education credit of around $2,000 too. So there was a few things we were able to do, but I think we converted maybe 70, 80 grand at a zero tax rate.
Wow.
And this it's grown substantially since then. She was able to get, she used some of the money to buy a house. You know what I mean? 5-6 years later, she was able to, there was a lot of things that she's been able to do since that. And she, at the time, before I was even speaking with her, she wasn't even thinking about, something like this.
This is incredible.
Yeah. So it was a great thing for her, just overall in her life. You know what I mean? It allowed her to, now she has a significant chunk that's growing tax-free. Like I said, she was able to use the conversion amount because it's the way a Roth IRA, once you've had it for 5 years too, not to get too much into the weeds, you need to have an Roth IRA open for 5 years before you can take the interest. But you can take out, and also too on the conversion amount, right? You have to wait 5 years in order to take that money out, or else it gets reclassified from a tax perspective. She was able to take out her contribution, right, and use that as part of her down payment, later on. So she became a first-time homeowner, later in life. But at the same time, she was able to accomplish a lot of goals by just being smart, taking it at a time, when she wasn't working. The Roth, conversion, I want to say smartly, maybe intelligently, I should say. So it can be a great tool. There's just a lot of stuff going on. Make sure you have a full understanding before you do it.
Yeah, I think that's an important thing. Look at the whole picture. what are some common retirement allocation mistakes we see, or people should be looking out for?
Eric, do you want to grab this? You want me to?
You can take it.
No, I was just saying, I mean, target date retirement funds. I believe they are way too conservative in a lot of cases. That whole set it and forget it. This is where I think the customizable approach really needs to be looked at a lot closer. So when they talk about target date, here's what they're talking about. The risks that they're incorporating into that. They're not incorporating inflation risk. Okay, they're not incorporating increasing costs in healthcare, all these other things that are so detrimental in retirement. They're looking solely at volatility risk. So what does that account? How low could that account go in a year, 2 years, etc.? Those are the things that they're looking at, and a proper plan should be looking at, okay, just as we talked about before with bond laddering or having, cash available for your lifestyle for those, first 3 years, first 4 years. By doing that, you no longer have to have that target date mentality. Now you know you're setting it up for your life, how you live your life and the things that you want to do in retirement. You have the money set up for that, okay? And then the money that's for the future down the road, you're putting it in assets that are going to, again, keep up and beat inflation, keep up and beat, healthcare costs, things like that. And that is, to me, is just so important to have a good retirement. The clients who do that and understand that, they're all doing much better in retirement. People who are too conservative with their investments, it gets eaten away at inflation, and they're not able to do as much later on because of that.
Justin, one thing I see a lot, and it's kind of it's not really like an investing thing, it's a spending thing. A lot of people, when they retire, it's like a big release, right? You've been like delaying gratification for years. You've paid down your house, you put your kids through school, just getting by and saving. Now all of a sudden you have all this free time. You're like, what am I going to do with myself? We should have a ton of fun. How much time do we have left? But what we talked about, hey, maybe you got a lot more time than you think. And what we see is you get that second vacation home. You're traveling to Europe. You got multiple golf clubs. You're traveling a lot because you're seeing your relatives, your kids. And you end up spending way too much at the beginning. And it's because you've been so disciplined your whole life that and we see it happen all the time. The other thing we also see is the reverse, where people cannot get out of the saving mentality, and we're like, guys, enjoy life a little. Stop. You need to start spending a little. So we see it both ways, and having a good conversation with your advisor can kind of help you work through like what amount you can actually take out.
That's a great point. I think that's really important for people to hear. Kind of highlight that. Any last pieces as we like wrap up this main topic for people to take away, like action items or anything you think it's valuable right now that we haven't covered, Bill? I'll throw that.
No, I just did, I mean, just make sure that you're not too conservative, right? When your investments early in your career, you don't want to be in a position where you have to take risks later on, right? Because you say, geez, no, we have to take this risk on because things are not looking good, right? Yeah. Understanding healthcare, is a big part of everyone's retirement. Make sure that you understand what Medicare is going to be taken care of, and then your supplemental plans and things like that, and just making sure that your withdrawals are from the right assets and that setup is done in a good manner. So those are the things that are, and make sure it's customizable to your life. There are rules of thumb, like we talked about out there, the 4% rule, you know what I mean? These are just academic studies that don't deal with all the variables, right? This is what we think on average. Everybody's so different. Everybody's retirement number is different because everybody has different expenses or ideals about what they want out of their retirement. So to say this is how much you need for retirement, it's just like in life in general. If you speak about anything in generalities, it's probably not great. You want to make sure,
right.
It's almost like, do you really want stereotypes for your retirement? I don't think so. You know what I mean? You want it customizable to you.
I love that. All right, so Eric, anything else before we jump into our portfolio coverage?
No, let's get into it.
All right, we wanted to touch on Netflix this week and also Eaton, one of our portfolio, Eaton Corporation. So Netflix we've owned for a while now. Eric, I think this year it's performing pretty well. I mean, 43% year to date, up overall as a whole for the year. In the past 12 months, 98%. Woo. Fantastic.
Yeah, and
we're all familiar. We all have Netflix, I'm sure.
Can't get rid of it. So that as they raise the prices, customers don't leave, so they're in a strong position. They did really well because of the weaker U.S. dollar. Actually, they actually have a lot. Netflix has a ton of international exposure, so they made a lot of money there.
That's interesting.
The ad-supported tier, which they added what was that, 2 years ago, year and a half. That's been a massive success. Cut the password sharing. Everyone that was on a family plan that couldn't afford to pay for the regular tier, they go to the ad-supported tier. Netflix makes a ton more money.
It's very affordable too. It's one of the cheapest subscription-based plans, which I can appreciate. Right,
exactly.
$7.99 a month, and you have full access to their whole suite of entertainment.
It's hard to beat. Really good. Hard to cut when you're looking at what to cut for a subscription. Probably gonna keep that.
That's gonna be one of the last ones. Yeah, ad revenue is projected to double in 2025, jumping from about $2 billion to $4 billion.
Wow.
And then they have interesting stuff coming up with live sports and events, right? They're going into live entertainment with boxing, NFL games, WWE. So there's a lot of things to be optimistic about. I think it's gonna, they had a massive earnings beat, but it looked like pre-market it was actually going to open down. I mean, it's had such a run up. You have to figure investors have priced in that earnings growth then.
It's basically like you said, it beat analyst expectations. Guidance was great. Everything it was good. Wasn't so spectacular because it has done so well. It would have had to blown away. You know what I mean? Yeah. Blown away analysts. You know what I mean? And also the guidance would have had to have been incredible in order for this to pop in any way. So surprisingly it is down. I saw maybe right after it was, between 1% and 2%. I think it's between 2% and 3% this morning. But the performance, right, has been so incredible. They're just hitting on all cylinders. Talking about deals with, potentially the UFC, getting into more gaming. There's still so much growth, I think, in that, in the sense that they can maintain current customers. They still have room to potentially raise rates.
Yep.
And all that new content in terms of live sports, different sporting groups, things like that, and getting into, like I said, more video games, other types of content, things like that. We've talked about maybe even doing some kind of parks and stuff like that in the past,
leveraging their IP to expand it. Yep, absolutely.
What if they even get into short form content too? Obviously they've dominated, taken market share from linear television and other streaming platforms, but they could pivot and steal revenue from YouTube, from TikTok,
podcasts, right? There's a lot of stuff that they could dip their toes into and probably be very successful. They did say, the CFO said that even with all the landscape of traditional media and things like that, they have no plans to buy any of the legacy media companies or anything like that. They want to build. They don't want to They don't want to
Acquire.
purchase stuff.
Well,
Yeah.
you got to figure too, the longer this goes on, the more market share they steal, the valuation of those companies is going to go down, and they'll be even cheaper for them to purchase later on. So they're like, what's the reason to do it now?
You're out there. All right, so we got Eaton. Eaton's also on the docket today. Eaton Corporation. They are a multinational power management company. We bought them last year. What made us feel like it was an attractive acquisition? And Eric, why don't you just dive into it?
Yep. I mean, a lot of it was, we try to have a diversified portfolio. We wanted a company that was, in the industrial sector.
Yeah.
So we were looking there, wanted something that also had exposure to high growth markets. Eaton checked all the boxes, and had upwards earnings revisions, analyst buy recommendations, and it did well for us. Then when Liberation Day happened, it tanked because cost of all their materials went up. Since then, it rallied from its bottom was $250 was the price, rallied all the way up to $380. And a lot of that, like good earnings, raised guidance, and they're going to see a ton of growth in the AI sector, aerospace. They're going to do very well.
Autonomous vehicles, right? They're building. They're like I like to say, they're a guts company, right? They build the guts behind a lot of things. So they don't have the sexiness and appeal of maybe some of these tech companies, but they build all the stuff that kind of helps them go.
Right.
So.
Equally or more important, yeah. So, I mean, Bill, how are you thinking about them right now? Current economy outlook. I feel like it plays well with a lot of things we've talked about, AI and bigger trends happening. But what are you thinking?
I mean, when you think about having like intelligent electronics and things along those lines, they're doing a lot of stuff in that space. And like I said, they're building kind of the guts for that. You talk about, everything that's going on with potentially like autonomous vehicles and some of the sensors and powertrain systems. There's just so much stuff that they're touching on that are in high growth areas that they're building for, and that these companies are going to need in order to build out that infrastructure. And they're there at the forefront doing that. So I think it's a great play right now. You get that industrial exposure that you want. While also still kind of getting access to these incredibly high growth areas, right?
Yeah.
It's a great, like I said, great way to get exposure to both areas there.
Yeah, it's a great time to have Mag 7 companies and U.S. government as your customer, right? Flush with cash. Every quarter after earnings, they announce, hey, we're going to keep spending this much on data centers and infrastructure build out. And guess who benefits? Companies like Eaton.
Yeah.
And there are also I think one thing that I really like pointing out, because a lot of times people say, especially these past 6 months, right, there's been a lot of talk, you need to have international exposure and things like that. And I kind of want to stress the fact at how many companies, especially in the U.S., do so much business outside of the U.S. Okay, so a company like Eaton, they're in 160 different countries.
Wow.
Is that a U.S. stock or is that an international stock?
It's international.
Answer that question, because I hear that all the time. You should have more quote unquote international companies. To me, that is a global company that is dealing all over the world, that has exposure all over the world.
Yeah.
And to sit there and say to be classified as a U.S. company, I think it is patently false. Right. Yes, it's based in the United States. Things along those lines.
Thank God it is. Otherwise, we wouldn't be the doing as well as a country.
But it is an international. You know what I mean? Is an international company, right?
That was the narrative when everything was down 3 months ago, though. Every article was the end of American exceptionalism, all this stuff, and you would have thought that you need to pull your money out of out of U.S. equities, and
yeah, we'll see how that
here we
plays
are
out
3
over the
months
next
later,
5,
and
10
they're
years.
all
that's baloney. Well, I mean, I think the data shows like foreigners were net buyers of American stocks throughout that entire time period. I think we covered that a couple episodes back. So
yeah, it was like a little
Crazy.
a little like
the headlines,
little bump in the road where they were showing they're reducing their exposure, but then as soon as things turned around, guess what? They were sitting right there at the doorstep. So
yeah. All right, so let's wrap up the show. I think there's a lot we covered today. If you're listening and still listening, hopefully you take away retirement is really not about age. It's about your timeline. It's customized to you. You got to look at the whole picture, really focus on everything. And I think it's super important to work with a coach, financial advisor to guide you through that, because there's a lot at play. But your health, family situation, and goals matter more than just basic generic rules. And yeah, anything you guys want to add as a final sign off here? No? All right. I think we covered everything.
no.
Just a reminder, this show, we don't make money on it all. It is for you, our listeners. If you're listening, be a friend, share with a friend, give it to someone who you think would find value in this show today. As always, you can always email us.
Some topics.
Yeah. We want to hear from you. We want feedback. We want this to be a two-way conversation. Let us know at hello@foxhillwealth.com or go to our website, foxhillwealth.com. Check us out there. Shoot us an email, and you can find us on all the socials as well, Fox Hill Wealth. That's it for today. We'll see you guys next week.